Analyzing debit and credit. Yes, this is the topic which is considered most difficult, or you can say most technical in financial accounting. But I call it most interesting topic of financial accounting. Before we move forward, just recall that there were two groups in which 5 main heads of accounts were divided: debit group and credit group. Okay, one more thing, just recall. In the debit group, we had assets and expenses, yes. And in the credit group, we had owner's equity, liabilities, income. Very good. So these are the two groups based on which we would be learning how to analyze debit and credit. So write somewhere in your notebook, debit group consists of assets and expenses. Okay. And credit group consists of owner's equity, liabilities, yes, and incomes. Okay. If you have written this on your notepad, let's move forward. So, while analyzing debit and credit, if there is an increase in debit group, it would be analyzed as debit. And if there is a decrease in debit group, it will be analyzed as credit. So, if there is an increase in credit group, it will be analyzed as credit. And if there is a decrease in credit group, it will be analyzed as debit. Very easy to understand. I repeat this concept in another way, that increase in assets and expenses, obviously, these are the debit group, would always be debited. And decrease in assets and expenses would always be credited. Increase in equity, liability, and income would always be credited. And decrease in owner's equity, liabilities, and income would always be debited. So, the same thing in which, like we saw, that debit group consists of assets and expenses. If there is an increase in debit group, would be debited. And if there is a decrease in debit group, would be credited. Yes, now repeat. For credit group, if there is an increase in credit group, would be credited, yes. And if there is a decrease in credit group, would be debited. Okay, let's repeat it in this way. Debit and credit. These are the two groups. Separately we can see. We are having these two groups with us. It is showing increase. If asset is increasing, would be debited. If asset is decreasing, would be credited. Okay? And then, if expense is increasing, would be debited. If expense is decreasing, would be credited. Okay? If equity is decreasing, would be debited. And if equity is increasing, would be credited. Same way, liability decrease, debit, and liability increase, credit. Income decrease, debit, and income increase, credit. But you have to remember few things that you have already learned in earlier modules. What's that? That each financial information, which is transaction or events or conditions, each financial information causes a change in financial status or financial position of the entity. And when we say financial status or financial position, we have to recall the accounting equation. In that accounting equation, asset is equal to owner's equity plus liability. And owner's equity includes profit, and profit is created by virtue of income minus expenses. So all 5 main heads are over there in that equation. What we see and what we have already practiced, that because of a transaction or event or condition, this equation will change its position. When we say change, change means increase or decrease. So either there will be an increase in any of the 5 main heads of accounts because of a transaction, event or condition, or there will be a decrease in any 5 main heads of accounts because of a transaction, event or condition. Such increase and such decrease will be analyzed as debit and credit. This is what we do in accounting. This is what we use, debit and credit, which are in fact the alphabets of accounting language. So, the approach to recognize debit and credit is that the financial impact on accounting equation is in fact being translated into debit and credit. Why I'm using the word translation? We translate from one language to another language. So, accounting is a language which is being used to translate a transaction given to us in English language. So we are translating a translation, we are translating a transaction which was given to us in English language into accounting language. This is the concept. So while translating, we are using debit and credit as alphabets. This is the approach that you should carry with you. So each transaction causes a change in 2 accounting heads. Remember, one is analyzed as debit and the second one is analyzed as credit. Very important to learn is the relationship between main heads and accounting heads. You see that these are the 5 main heads of accounts at the top row. And below each main head, you can see the accounting heads. So these accounting heads are in fact subheads of the main heads. Means assets are the main heads. Their subhead includes land, building, machinery, furniture, motor vehicle, etc., etc. Expenses is the main head, which include purchases, salaries, electricity bill, repair, etc., etc. Owner's equity, the accounting heads are capital, drawing, profits. Liabilities include bank loan and bank overdraft and creditors, accounts payables. Income includes sales, interest, commission, etc. Well, it is important to learn that main heads have few family members with them. The debit and credit is analyzed for each accounting head, which is in fact the family member of the main head. So, this is what, if you will learn well, you will never commit any mistake while analyzing debit and credit. The important tips to remember in this module are: debit or credit does not carry any literal meanings, since these are the alphabets. Each accounting Each account involved in financial information is analyzed for recognizing debit and credit. Thank you.